On June 12, 2026, SpaceX completed the biggest IPO in history, $75 billion. One day, one company. The number no one is talking about, $20 billion in debt, already on the books before the opening bell rang. 1 week after that record-breaking listing, SpaceX's bankers started calling institutional investors. They needed to sell $20 billion in bonds. Not to grow the business, to pay off a bridge loan that expires in 15 months. SpaceX took out that bridge loan in March 2026 to absorb xAI, Elon Musk's AI startup. xAI lost $6.35 billion in 2025. SpaceX absorbed it anyway, and now the bill is due. The IPO raised $75 billion. It did not retire the debt. 3 major credit agencies issued investment-grade ratings on June 18th. The same day, SpaceX dropped nearly 4%. The bond deal investor calls begin as early as next week. The clock is running. This is Wealth Brief. We cover the business and AI stories that actually move markets and affect your money. New video every day. Here is the full picture. By the numbers. Starlink generated $11.4 billion in revenue in 2025. Its EBITDA margin sits at 63%. Its operating income hit $4.4 billion at a 39% margin. Starlink is the only division inside SpaceX that makes money. xAI contributed $3.2 billion in revenue against a $6.35 billion operating loss. That loss now sits inside SpaceX's balance sheet. SpaceX posted $4.28 billion in total losses in Q4 2025 alone. Anthropic is paying SpaceX $1.25 billion per month for compute capacity. Google is paying $920 million per month. Those contracts lock in Starlink's infrastructure for 3 years. 5 banks are running the bond deal: Bank of America, Citigroup, JP Morgan, Goldman Sachs, and Morgan Stanley. The deal targets at least $20 billion. It refinances a bridge loan that carried an interest rate of 4.58%. Before the IPO, SpaceX's debt carried a 12.5% junk rate. The investment-grade ratings change that math. But $29 billion in total debt at 4.58% still costs roughly $1.3 billion in annual interest. Mainstream coverage calls this a routine refinancing. It is not. Starlink subscribers, paying monthly for satellite internet, generate the operating income that covers xAI's losses. That same Starlink infrastructure is now contractually committed to Anthropic and Google for 3 years. SpaceX cannot redirect that compute capacity to grow Starlink's own margins without breaking those contracts. The S-1 prospectus disclosed related party transactions with xAI, but did not fully quantify the capital flowing between the two entities. Investor scrutiny of those omissions forced the company to amend the filing in June. The core mechanism is this: Starlink earns it, xAI burns it, and the bond market gets asked to bridge the gap. 3 investment-grade ratings make this bond deal viable. That opens SpaceX to institutional buyers, pension funds, insurance companies, fixed-income ETFs, who cannot touch sub-investment-grade paper. Morningstar's DCF analysis puts SpaceX's fair value at $62 per share. The market was trading the stock near $175 at listing. That is a 170% premium to Morningstar's estimate. SpaceX shed roughly $620 billion in market cap across 2 sessions after the bond deal was reported. The bull case is real. $1.2